Hey guys, I've finally found some time to sit down and walk you through a really important shift that's been happening in the financial markets. And in my experience, this affects basically anyone with a retirement account. We've all been told for years to just buy the index. But what happens if that very advice is making the entire system, well, more fragile? Understanding this paradox is, I think, crucial for how we think about long-term investing. Okay, let's dive right in. So basically, to really get what's happening, you have to look at how the market has fundamentally changed. On the left here, you've got the old guard. Think of legendary investors like Warren Buffett. Their whole philosophy is built on being price sensitive, finding good companies at a fair price. It's a value-driven world, and it's built on this idea of mean reversion, the theory that what goes up must eventually come back down to its average. But on the right, we have the new machine, the world of passive index funds. And this machine is price insensitive. It doesn't ask if a stock is cheap or expensive. It's driven by one thing and one thing only, the flow of money. And that creates a powerful momentum bias, which is just a completely different set of rules for the market. Now, before we get into the potential problems, we really have to acknowledge why this whole revolution happened in the first place. The reasons passive investing became so popular are honestly very compelling. So for decades, right, the advice we've all heard is that buying a simple, low-cost index fund is the smartest way to build wealth. And honestly, it's been great advice. The fees are incredibly low, it's super simple, you're automatically diversified, and this is the real kicker. These funds have historically beaten the vast majority of professional active stock pickers. The evidence for this has been just overwhelming for a long, long time. And this strategy, it hasn't just become popular, it's become completely dominant. I mean, look at this. Today, over half, 54% of all the money in US stock funds is now managed passively. This isn't some niche strategy anymore. For all intents and purposes, it is the market. But here's the core issue we need to explore. What happens when a strategy becomes so dominant that it actually starts to change the very structure of the market it operates in? And this is the crucial question we all have to wrestle with. I mean, we all learned a certain set of rules about how markets are supposed to work, based on value, fundamentals, and price discovery. But we really have to ask ourselves, are those still the rules of the game today? A lot of this thinking, at least for me, comes from the work of a market theorist named Michael Green. He's been at the absolute forefront of this research for years, and he makes this compelling case that the simple mechanics of passive investing have become the primary force driving stock prices, maybe even more so than company earnings or economic fundamentals. And this brings us to the central concept, what's being called the Inelastic Market Hypothesis. Now, the old way of thinking was that the market was elastic, that it could absorb huge amounts of new money without prices really moving much at all. This new theory says the exact opposite, that the market is actually highly inelastic. And because of that, every new dollar that comes in has this huge magnified effect on prices. So let's walk through how this machine actually works, step by step. Because in my experience, once you really see the mechanics here, the way you view the market will probably change for good. Okay, what's really interesting here is the core difference in mindset. The price-sensitive investor on the left, that's the human filter. They're asking, is this stock actually worth the price? They react to price, right? They buy what they think is cheap, they sell what looks expensive. The price-insensitive investor on the right, though, operates on a simple but really powerful algorithm. If I receive cash, I must buy. Price is just not part of the equation. And this creates an incredibly powerful feedback loop. Let's just walk through it. Step 1, every 2 weeks you contribute to your 401k. Step 2, that cash flows into a passive fund, and that fund is mandated to buy all the stocks in the index. Step 3, it has to buy them in proportion to their size, so the biggest companies get the biggest slice of your new money. And this mechanically pushes their prices up, which, guess what, makes them an even bigger part of the index, ready for the next round of contributions. You can see how it just feeds on itself. The scale of this effect is it's stunning. I mean, there's this groundbreaking academic research that found that for every $1 that flows in the market, the total market capitalization increases by about $5. Not a few cents like the old theory suggested, $5. That's an absolutely incredible multiplier effect. Okay, so now that we get the mechanism, let's look at the consequences. Because while the market might look calm and strong on the surface, this new structure, I think, creates some pretty serious but often hidden fragility. So what does this new world actually look like? Well, first, we're seeing a permanent momentum bias, where the biggest get bigger just because they're big. This leads to what some are calling the death of mean reversion. That old idea that overvalued stocks come back down to earth is being overwhelmed by this constant tide of passive flows. Everything also starts to move together. And maybe most importantly, price discovery, that whole process of figuring out what a company is truly worth, starts to break down. Prices begin to reflect the flow of money, not the underlying business itself. And this chart illustrates the point perfectly. It shows the S&P 500's valuation over time. And you can clearly see that as the share of passive investing has exploded, valuations have climbed and stayed far, far above their long-term historical averages. To me, this suggests that prices are becoming more and more disconnected from the actual earnings of the companies. Now, here's the great irony in all this. This whole dynamic makes it almost impossible for active managers to outperform. It's not necessarily that they've gotten worse at picking stocks. It's that they are literally fighting a tsunami of price-insensitive money that only reinforces the index. And of course, when they underperform, what happens? More people give up. They move their money to passive funds, which just strengthens the whole feedback loop all over again. This is the multi-trillion-dollar question, isn't it? I mean, if this machine creates a $5 boost on the way up for every dollar that comes in, what happens on the way down? The logic suggests the market will be just as inelastic when those flows finally reverse. So what could trigger a reversal? In my view, there are a few pretty probable candidates. You could have a major recession that halts all those automatic 401k contributions. Then you've got demographics. An entire generation of baby boomers is now entering retirement and will have to start selling assets to live. Or, it could just be a sudden market shock that causes a crisis of confidence and leads to mass withdrawals. The real danger here is that when the selling starts, there won't be enough of those old guard active investors left to step in and say, hey, this stock is now cheap, I'll buy it. That human layer that historically provided a floor for the market has been, it's been hollowed out. And without it, you risk a self-reinforcing cascade, or forced selling from passive funds just pushes prices lower and triggers even more forced selling. So here's where it gets really complicated for us as individuals. This all leads to a very, very difficult paradox. So this table really lays out the paradox. Even after understanding all of these systemic risks on the right side here, the fragility, the distorted prices, for any single one of us as individuals, choosing a low-cost passive index fund still remains the most logical and rational financial decision. The benefits for the individual are just too clear and proven to ignore. And this sets up a classic tragedy of the commons. We are all making the smart, rational choice for our own portfolios. But by all doing it together on such a massive scale, we are collectively making the entire system more fragile and more prone to the exact kind of crash we're trying to protect ourselves from. We're all kind of trapped by this dynamic. There are definitely no easy answers here. And the point of all this isn't to tell you to sell everything and run for the hills. The point is that the game has changed. The market that you're investing in today is not the same one your parents invested in. It's no longer just an information processing machine, it's become a flow processing engine. And just knowing the rules of that new engine is probably the most critical first step you can take for your own financial security. Anyway, I hope this helps, and if you have questions, just let me know.